Hello and welcome to the Stockout. I'm Mike Baudendistel here from FreightWaves, joined by Grace Sharkey. Grace, good to see you. Good to see you on FreightWaves Now this morning, talking about consumer debt, the all important topic.
Yeah, it's we'll dive into it in this episode today, but it's so strange to see so many signs of what should seem like struggle when it comes to consumer demand or spending, but still so many surveys that showcase that we're going to see an active holiday season. So I think it's going to be interesting. We'll of course dive into it later in the episode too.
Yeah, so we'll talk about that today, and then we'll talk about Instacart, which those shares have been weak since going public. So some of the same concerns that we expressed, a few weeks ago when we talked about that IPO when they released their prospectus. It seems like others are concerned about that as well. The street's been concerned about it. I mean, it has been a situation where the stock market's been kind of jittery, and some of these more riskier names have come down, but that one's come down quite a lot from the IPO price. We'll talk about that. And then we'll talk about Craig Fuller's article. He put out an article, I think it was Sunday, October 15th. And that was one that I think you have particular insight into because of your experience in the freight brokerage industry. It was really kind of a follow-on to the latest state of freight discussion, where it's just sort of, went into more detail on sort of the thesis. In that discussion, we'll talk a little bit about Rite Aid filing for bankruptcy. I think most people saw that, maybe weren't shocked, considering that they've been under financial pressure for a long time. And then a preview next week's episode, which I think is really going to be a good episode, with our friend Chris Moe at Cartograph. And Chris Moe is an expert in all things related to Amazon. And so we'll talk about that. But I want to start out with talking about the topic that you talked about this morning in FreightWaves Now. That's the consumer debt, and we want to show a table that they had on the New York Fed website, which sort of breaks this down by the various tranches. And so, you were talking primarily this morning about credit card debt, and you do see that on the third to bottom row, up 45 billion in the previous quarter, and up 144 billion year over year. And so it's a little over $1 trillion. I think it's the first time it's been over $1 trillion. But you see all these other categories too, and almost all of those are up. I mean, you do see, interesting, the mortgage debt's, down, just a little bit. I think that's a function of just the hasn't been a lot of homes turning over lately. There's like the fewest number of homes turning over in many years. But still on an annual basis, up 627 billion to 12 trillion of mortgage debt. At least that's secured by the home, value. And then you see, student debt coming down. You do see people that made the payments in order to avoid interest expenses when the interest started up again. So that's maybe to be expected. But then you see autos, and autos is almost as bad as a credit card. On an aggregate basis, it's more. At least that's secured by value of an asset, albeit an asset that's depreciating, but you see that's up annually $80 billion to $1.58 trillion. And then other, which I guess would be like other types of personal loans, you see that up as well. So all things considered, the total consumer debt, revolving and non-revolving, up $909 billion to a total of $17 trillion. That is a big increase in 1 year, and it does, concern you. And then we have a couple other charts from the Fed. So this is consumer debt payments as a percentage of disposable income. So this excludes mortgage debt, and so this is basically the cost as a percentage of disposable personal income to service the debt. So basically interest payments, and you see that's crept up to about the highest level since that 2009, recession, and just under 6%. And there's another one that's a little bit more encouraging. That's similar. This is the debts service for mortgage payments. And so this is for homes, and you see this being about 4% of the total, whereas it had been during the last the Great Recession up as high as 7%. So that's a little bit more positive, but that doesn't really seem sustainable given that we've had such a sharp increase in mortgage rates, those are closing in on 8%, a lot higher than they were. So when you look at those various charts, what stands out to you?
Well, I think just the what seems clearly not encouraging, and maybe for the rest of this year and spending we don't see it, but really going into 2024 is just how the consumer is going to be working on paying this back. I mean, we had a interesting discussion this morning too on like long term versus short term and what people are considering when they're looking at the debt in front of them. But I think there was an article I had shared with you that showcased just over the past year, yeah, $116 billion in new credit card debt. And what was interesting about this, I think it was a Wallet Hub survey, there was $88.4 billion that just came from holiday spending alone. So I guess it makes me nervous to see such positive outlooks on at least what could be seen as positive outlooks for holiday spending even this year, and then considering adding on to all of the figures you just shared going into 2024, where we've even discussed, I mean, here at FreightWaves, seen a more positive freight market. But for me, it's just, it's difficult to wrap my head around when we're going to see the average consumer or the average debt holder in this case starting to pay this all back. I mean, we have student loans turning back on. You technically still have another year to avoid that if you really wanted to, but it just
Mhm.
seems like unless we continue to see positive information on jobs, like we saw this past month, it seems like a very interesting conundrum that the average American consumer has got themselves into.
Yeah, I think there's been so many individual pressures, but I think it's just really the inflation that's caught people off guard. That we were just
Yeah.
sort of in this lull that inflation would be 2 or 3%, and then it went to the high single digits and close to double digits, and it was just this is not a inflationary type environment that people are used to, and went 2 years where inflation outpaced people's income growth, and I do think some of those inflation numbers are just understated. Also, some of those federal numbers, because it just doesn't seem like even those numbers are kind of the reality of those prices that I've seen. So I've always sort of been a little bit skeptical of those things. And so I guess it brings up the next question is sort of which um, sectors in either CPG or retail more broadly are most at risk from having a indebted consumer.
If I had to choose, I would say probably retail over CPG. I think, if anything, especially with like trends we've seen with just even food shopping in particular, groceries in particular, I think that's an area where consumers are considering first that they need to, of course, continue to spend and be strategic in that spending as well. Surveys have shown that store cards for a lot of retailers, so those like Target, Macy's, J.C. Penney, throwback there, have been reporting all lows when it comes to incomes declines on their store cards, delinquencies on their store cards, and just overall people submitting for store cards too. It's funny, I actually have a friend who works at Best Buy who said that they're getting more pressure as ever as employees to really push those cards because they're seeing less and less people even applying for them or getting even approved for them as well.
Mhm.
So I think looking at just the way that or where that credit card spending is usually put and where some of this this debt is considered more so, I would say retail over CPG any day at this point.
Yeah, I would agree with you. Although we have seen some increases in elasticities for CPG, you sort of go back a year or so, year or two, CPG companies are saying, "Yeah, there's a lot of inflation. We're raising our prices a lot, but really haven't seen any change in our volume." But now they are seeing changes in their volume, which just shows consumers are under more pressure than it was a year or two ago. It's still not terrible. It's still some of these companies are raising prices. Let's say high single digit, maybe raise the price 8% and they get a 4% reduction in volume or something like that. So it's still maybe less than you would have expected, but at least it is bigger than it was before. Is there anything to be made of this kind of emerging thesis that a lot of the younger generation is priced out of coming up with enough for a down payment on a house or having enough for a new car, that they just sort of throw their hands up in the air and say, well, there's no point in saving up that amount of cash that I would need for some of these big ticket purchases. So I might as well just spend it on on more immediate gratification, which seems completely counterintuitive. It seems like if $400,000 house is now $800,000 house, now I need $160,000 for a down payment instead of $80,000 for, let's say, 20% down payment. But do you think there's anything to be made of that that thesis?
Uh, a thousand percent. I will say, especially depending on when you bring up the mortgage aspect. I mean, looking at there's some like suburb areas and just different very good like areas to raise a family that I've been watching prices just not even making sense for the even going inside the home and seeing, but just competition, right? Uh, a lot of I'd say our generation is losing out on others that are looking in the market today, and I think it is getting to that point. I mean, a little definitely a little bit different of a market, but about a year and a half ago, even I was looking, and you would go and look at a property and get a call about 2 hours later that someone paid in all cash, and so it's someone who's I'm taking care of my student loans and a lot of my debt, but still building that cash incentive up. It does get to a point where you're just like, you know what, maybe I should live that YOLO lifestyle and just live in the now, rent until I die. But I will say the mortgage side and the car side as well, right? Like looking at what's of value and what's available out there. Our my generation, millennials, might be feeling that pain a little more, and I'm sure those underneath as well. And that's where I do get concerned because the fact that I mean in schools we barely teach finances to begin with, and then being in this this atmosphere that we're in today, does the younger generation know how to spend and spend appropriately? And we can talk about this too, but the buy now, pay later options, that's huge among Gen Zs and millennials. And as much as it seems like a better way to purchase items and avoid interest rates in particular, we're doubling down on it. And it's still debt, just a little bit more of the short term. And
Mhm.
I agree. I think it's these different maybe debt options in particular that are being offered to our generation is pushing back the capabilities of being able to afford mortgages or even auto loans, depending on what you're looking at. So yeah, I would definitely say I think there's that frustration going on, and I think even myself, I'm like I'd love to see some of these rates go down, but it's not happening. So people are really kind of questioning. I think yeah, those long term plans and what comes next. But there are other options, like I said, buy now, pay later, that are almost making the situation worse for those who might not be able to completely wrap their head around their finances at this point.
Yeah, I grew up in the Chicago area, and in Illinois, there's a state requirement in order to graduate that you have to have a consumer ed requirement, and you have to take a consumer ed course, and so you have some semblance of knowledge about why you don't want to, have a huge interest rate, or a huge credit card balance, et cetera. But I want to move on to this next story, which is, Instacart. We had a show, a few weeks ago about Instacart, and went through the prospectus a little bit, and went through some risks, and it seems like some of these risks are shared. Some of these concerns are shared by the investment community. So this went public at $42. It's since retreated to $25.20. So it hasn't been a great return. Only 8 companies have gone public since Instacart, and some of the concerns are just competition across all these other lines of other lines of businesses. DoorDash, Uber Eats are two of the things that are maybe potentially competitors. But I think the big competitor I'm would be concerned about is just some of these major retailers like Kroger and Albertsons combining. I think that hurts them. We'll see if that actually gets approved by the FTC. I suspect it will. But other things like just Walmart, building out their capabilities as well, and CPG company. Yes, they could, advertise on Instacart. They could also take those dollars directly to the to the retailer. And it goes to saying, well, Instacart has been sort of growing the advertising revenue and sort of, making the margins look better. But what it's struggled at is just keeping the volume growth in terms of, the number of transactions sort of always growing. And so you do wonder if some of this was kind of a pandemic era type behavior, and, other companies being more aggressive in this space, hurts them, because I think maybe the revenue for uh, advertising can only be so much out of proportion to the overall transaction volume.
Oh, I definitely think it's a pandemic era hot topic. I mean, you saw Shipped Right is one that I used in the past. With Kroger actually purchased that up as well. So to talk about that competition, that's huge. And the percentage points on some of these transactions are just so incredibly high that I think consumers are going to really start to think twice about whether or not just taking a walk down the block, or better
Mhm.
planning their day to pick up these items, right? Like this, it made sense when you couldn't leave your homes, or for instance, like remember a lot of grocery stores are only open certain hours of the day. To better plan for your family during the pandemic, it was very useful. And I just think that's fallen off. I mean, I was looking at there's a grocery chain up in Michigan called Meyer, and I was just looking at their Instacart prices compared to just having Meyer deliver through Ship, which is one of them. And on Instacart, they're about 17% higher pricing than either just going to the store, and I think it was like closer to 10% of going through Shipped. And for right there, we're talking about, right, how the consumer seems to be very frugal with where they're putting their money, and they're still planning on spending a lot for the holidays.
Mhm.
I mean, that right there is some huge cost savings that I would make sure is still in my pocket. And of course, I think what's fighting against it too, we have oil prices is one thing to look at, but as those move with the market too and potentially go down, that's another area where it's like, why am I paying these extra fees on top of fees when I could easily just put this back into my schedule and not have to pay this amount? You bring up the advertising too. I mean, Walmart is just as dug in its advertising and its own marketplace too. So I think even the ad aspect is something that's and I don't see long term growth in with the competitors that are out there, and even the vendors that are within the Instacart
Mhm.
portfolio.
Yeah, your time has to be pretty valuable, I think, in order to sort of make the numbers work. There, I don't mind going outside, going walking distance from Trader Joe's. I just have to avoid the impulse purchases. They have 1,000 different types of craft beer on the way to the
Yeah.
checkout line. But I want to bring up this next article. This is an article that hit on Sunday, written by our CEO and founder Craig Fuller, and I think you really have unique, insight there. So Craig writes about the freight recession, unlike others in history, and really this was a follow-on to what was discussed at the State of the Freight webinar. And I do think if there's one webinar that you join every month, that should probably be the webinar. And the point that was made on that webinar was that you go back in sort of previous cycles, that the freight brokers had a much different position in the marketplace than they do now, and much more of the freight space goes through brokers now, something like 20%, versus you go back in previous cycles, it was more like 6%. It was a nascent industry in 2000 when that was the case. And it's a bigger part of, let's say, shippers routing guide. They almost feel like these are kind of, they're almost like a core carrier, even though they don't own the assets. And it's not sort of a situation for just freight on the fringes where truckers desperate to get out of a certain lane, so they're really taking advantage of the carrier by having basically next to nothing. And sort of the so what of all this is that it's keeping some of this capacity in the market for longer than it otherwise would be, because it's allowing carriers to find loads that they wouldn't be able to carry. Fine, broker takes big chunk of the margin, but it's sufficient to keep truckers moving and have cash flow coming in to keep them in business. And it just essentially keeps the freight market looser for longer. And, you have a lot of a background in brokerage. I wanted to see what you thought about the article.
I thought it was spot on, especially, I do the radio show as well, and I can't tell you once a week I get good old, do carriers even need brokers argument? So honestly found it refreshing, to be honest with you, to see this out there. And also consider just the last couple of years. I mean, brokers in particular, when the market was flipped in favor of carriers, they were doubling down on carrier reps, trying to build as many relationships as they could with these small carriers. So those who focused on that during that time have this incredible pool of small carriers that they're working with, but not only working with, talk about visibility tools, have actual visibility of where that capacity is, and are offering a lot of these carriers better incentives and better programs than they have in the past. And so what has that done? It's created this really great pool, again, of small carriers that they can pull from. And I think what really showcases that they need each other, carriers and brokers, more than ever, is exactly Craig's point. I mean, at the end of the day, shippers are coming to freight brokers as really almost like their managed services, and at some point, if not bringing some of those big good brokers in as managed services and playing this overall core carrier role, which means that those freight brokers then have to understand that the carriers, and the small ones in particular, that get them usually the best margins and the best cost, at least especially cost savings to those shippers, are the ones that they need the most. So it's just, I love the article because I hope that people read it in our industry, brokers and carriers alike, and they can truly see and maybe hear a little bit better how important each role they have to each other. And I just think coming off the market that we had, this is almost doubling down on that small carrier relationship. We were looking left and right for every single carrier we could find to deal with the capacity. I guess not problems, but capacity overflows from the past market, and this is the outcome. And I think it's why those digital players are showcasing more of a RFQ strategy to their shippers too. They understand that the brokers have a really great role to play right now in this market, and the fact that we are seeing so many small carriers staying to play yells two things for me. One, brokers are still working and making sure that shippers are seeing some cost savings, even in the market we see today, and
Mhm.
probably likely because shippers are pissed for paying so much over the last couple of years. And two, they're paying the carriers as fairly as possible in the market that is out there because they know they can't lose them or else this whole thing crumbles. So I loved it. I think it was a really great analysis of not only what's happening today in the market, but really how we got to this point. And again, for the back and forth of who needs who, hopefully both parties left this realizing that they kind of need each other in this market and the markets moving forward as well.
Yeah, that's good because for so long it seemed like all of the entrants in the freight industry were non-asset based brokers. That's all anyone wanted to invest in. Let someone else take the risk of owning the assets. That's a horrible business model. But not everyone can be a broker. At the end of the day, I mean, someone needs to own the assets. So it almost seems like it's kind of the carriers being treated fairly as a result of market conditions, and almost there being too much of a proliferation of brokers trying all going after the same load. So I thought it was very
Yeah.
interesting. Also, we have about a minute left. I want to go through this one last story. You probably saw this. Rite Aid filed for bankruptcy, and I look back at my stock out newsletters. And exactly 1 year ago, one of the things that I highlighted in the article in the newsletter was something written up by a company called Credit Intel, which analyzes the income statements and balance sheet and cash flow statements of various companies to give other companies that do business with them a heads up that they could be in trouble financially. And one of the things they highlighted in October of 2022 was they gave Rite Aid between a 10 and 50% chance of filing for bankruptcy within 12 months. So right as the 12-month period hits, they called it well, and this is going to be a restructuring, so there still might be some of those stores around, but would expect there to be fewer of them. This is part of the settlement related to the oversupplying of the prescription painkillers. What a disaster that was. They're also kind of a distant third between CVS and Walgreens. But any thoughts on Rite Aid? Have you ever been to a Rite Aid?
Yeah. Not for a long time, I'll say that. Probably the last time I needed a prescription, and actually that was Walgreens, so no. No, it's last time I was in a Rite Aid, didn't love the inside of the store too much, so I don't think there's a ton of investment of what's happening inside. Haven't checked out their website, but I'll tell you, I know talk about doubling. Walmart is doing a lot in regards to more of the health services. You see some of these bigger guys really focusing on their pharmacy services as well. So, not surprised by this one, and probably should have made a bet on this. Sounds like a year ago.
Yeah, I don't know why it needs to exist. It seems like there's so many CVSs absolutely every place that that's sort of getting to be the market, them and Walgreens. But next week, join us for a discussion about Amazon. And that's all we have for today. Hope everyone has a good one.